Hey everyone, how's it going? Good to see you guys. Hey Illinois grain farmer, good afternoon. Mike, roller coaster today. Yes, we got quite a bit of volatility. John, hello. Monkey, hello. Tsunami Shay. Yeah, we did have
Hey everyone, how's it going?
a
Good to
little
see
bit
you
of a
guys.
tsunami scare yesterday or last night. But, nothing came of it, just big currents, big waves at the beach, no flooding or anything like that. So we're good over here. At least from what I've heard, all of Southern California, same thing. Maybe a little bit of action in Northern California, but we were just fine. So Telegram channel, if you guys are interested, tradingpub.com/Kane. Again, watch out for scammers. I'm not going to go through the whole spiel on that today, although I should keep on doing it. So I don't want to get complacent about that, but just be aware of scammers. I'm not going to ask you for crypto. I'm not going to ask you to invest your money for you or anything like that. Okay. So a little bit of a roller coaster today. Let's take a quick look at what happened in terms of the SPX. And yeah, you can see chop pretty much all day long. And then Powell started talking about the first thing he said was something like, anyway, he implied a couple of times that it'd probably be less likely that there would be a rate cut in September. He basically directly implied that once or twice, and then several times he said that we're waiting for the data, we're waiting for the data, we're waiting for the data. And yes, we have more information than we had before, but we haven't seen the impact on the economy yet. And then that's when all of this started to happen. And the market did not like that. But look at that. I mean, we went below this purple line here is the EMA 8. Look how smooth that was right until here. So this is basically what we expect to see because this is the daily EMA 8. We don't expect it to really move all that much, but boy, it did get choppy at the end right there. And the market, though, the SPY did get bid back up right above that EMA 8 towards the end and towards very close to that VWAP. So what that means for us on an intraday or daily basis is that we did absolutely nothing. Again, down 0.13%. We did cross and touch that EMA 8. That's what we were looking for yesterday. And so, yeah, we touched, and technically, we are, at least it's looking like, very good chance that we're going to bounce because we crossed back above. Tomorrow, all we need is a green bar with that high similar to or above today's high, and that'll be an official bounce off of the EMA 8. So that is positive news. That means this market is still bidding up, and it's still taking supply. So some people didn't like Powell's comments, didn't matter, sold off, and then there were buyers to come in. That is the sign of a strong market. So at least as of right now, not really seeing a slowdown in this trend upwards. And that pullback to the EMA 8, if it does bounce tomorrow, that is sufficient for at least another couple of weeks of moving higher. And if we start to leave that EMA 8 again, then we'll start talking about pulling back down and maybe all the way down to the EMA 20 this time and so forth, so on and so forth. We'll have to see what it looks like at that point in time to see if, hey, do we still think that there could be 3 to 5% pullback, or is it just going to be this tiny little mean reversion again? All right. So right now, we're just going to treat this like fairly optimistic. I don't want to front run it or jump the gun or anticipate, but chances are reasonably good that we're probably going to get a bounce off of that EMA 8, in which case that would be a green light to keep on putting on some trades, some bullish trades, shorter term bullish trades in the strongest sectors. So we'll take a look at those as well. Before we do that, I pointed out in my Telegram channel, I'm not going to talk about the gamma levels today because there was no point to them. They were basically all over the place. The market didn't know what to do. Yeah, so that's the risk of market makers was spread across several strikes, and it did point to choppiness until the very end there, where there was some bearishness pulled in all the way down to 630, Obviously, we didn't get that far down, and then it got bid back up. So gamma was not really helpful today. We probably shouldn't have traded all that much today. I didn't. I don't know if anyone else was telling you to, but or if you did, but it wasn't a good idea. So once again, volatility, which is what we have with the FOMC reporting always after the announcement during the press conference, we always get volatility. Sometimes we get really, really extreme volatility, and that volatility destroys technicals. So that's what I've been emphasizing for about a week now is volatility will destroy and will take over and will become more important than whatever you see in the technical patterns. So it's always a good idea to either sit that out, or you trade volatility, or you go into a market that is not going to be affected, doesn't experience that same kind of volatility on the particular catalyst that is causing it inside the equities markets. So if we look over here in the Fed Watch tool, let me refresh that because that might have changed. But over in September, you can see now that there is currently a 55% chance of nothing. So, or sorry, not nothing. What are we doing? Yeah, we are currently at 425, 450. So there's a 55 chance of no rate cut right now, which means 45% chance of a 25% rate cut. There was at some point in time last week, a month ago, people were thinking 50 basis point rate cut at almost a 20% chance. That went down to 2.5% last week, 1.3% yesterday. Now 0% chance. The bond market is not thinking at all that we're going to get a 50 basis point rate cut anymore. And that 25 basis point rate cut went down from 75% a month ago to 63.3% yesterday, all the way down to 45%. So that's what I was talking about earlier. As Powell kept on speaking and answering questions, then suddenly the market was like, oh shoot, it doesn't seem like we're going to get that rate cut that we were hoping for, that we were priced 63% chance in. Now we're only pricing 45%. That was that drop off in, that's the wrong one, over here. That's that drop off. And then we settled in at about 45%, and some bullish players in the markets are like, we don't care. We still think everything's bullish. We don't need that rate cut in order to remain bullish. And so that got bid back up. The point is, though, we're not anticipating that rate cut anymore. If the market can stay bullish in spite of not less probability of a rate cut, that just indicates a stronger market. We are going to be emphasizing those earnings a lot more, especially now that we have several of the economic indicators behind us. So it's probably a good idea to take a look at some of those reports. So at least for the Mag 7s. So I'm pretty sure Microsoft and at least one other mega cap reported today, or this afternoon. So just a few minutes ago. So let's do earnings date is today after market close. That run? It already ran? I didn't see it. I didn't see the change. So Microsoft and Meta, both, Qualcomm, ARM, LRCX. So a lot of tech, a lot of SMH type of stocks, Hood also. Let's take a quick look at a few of these. So I'm going to put this on the side of my screen. Then we can take a look over here. So we've got Microsoft. Still long arc Rocket Lab based on my bullish bias. Okay, how's that doing? I haven't looked at it in a few days. Okay, there you go. Bounce off of EMA 20, poked its head above the EMA 8. So we did get a bounce confirmation, and that EMA 8 did start to very slightly turn upwards. And so that's an early indication that a reversion back upwards. So things are looking pretty positive. Got earnings coming up somewhat soon, so just got to watch out for that. If we, no, I was looking at Microsoft. Meta crushed earnings. Okay, right. I'm pretty sure. Yeah, look at Microsoft post earnings. That's quite a jump upwards. I don't know what was priced into it. Let's take a look real quick at the options. See if that, at least it shouldn't have collapsed quite yet. So that market maker move was 17 at the end of the day, and it moved, so far it's moved 35, so double that. So if you were an option seller in Microsoft non-directionally, you got destroyed. Or if you went short in any sort of way, didn't matter if you're a seller or a buyer, if you're directionally short, you got destroyed also. So in this case, it's the gamblers, the people who bought long calls, they probably crushed it. Yep. So Microsoft doing very well. That's going to bode well for the markets tomorrow. We got Meta, yeah, very good also. So that's going to be a bounce off of the MA50. And then, so we don't usually look at technicals because of the volatility when you look at earnings. So that's going to be a gap up event, assuming that it opens right here. So that's 65. And we're looking at 40. So again, the gamblers who bet long, they are going to make some money over here. So that is net very, very positive. Those two Mag 7s, very positive for what the market is likely to do tomorrow. Let's see if, yeah, you can see post market, right after we got those two earnings announcements, we are up to 637 when we closed right about 635. So it's having its effect. I'll take a quick look at a couple other of these. Qualcomm down, but that's going to be overshadowed by Microsoft and Meta. ARM down, so not looking great for semiconductors, but Mag 7s, okay, here we go. LRCX up, that's a balancing effect for those semiconductors. And then let's look at Hood. So far, not much of a reaction. They've already reported positively. And let's see if there's any like big players here that might affect the entire market, not just their sector. I'm not seeing anything huge. Okay, Carvana might be interesting, but it's not going to be market wide. Nice big gap up so far in Carvana as well. So overall, it's looking pretty bullish, and we'll see what that means in terms of the market. There was a lot of positioning in the SPX for the last month at 6,400. I got 6,400, so we're pretty close to that. So there's a good possibility of us reaching that, I think. Tomorrow, we tagged it yesterday, last couple days, and there is also positioning, quite a bit of positioning at 6,500. I'm talking about gamma. So this is the market makers exposure, but they have exposure because people are buying calls over here. So there are market forces betting on movement upwards, continued movement upwards. This looks like a couple weeks worth of movement. So that's not unreasonable, that's 6,500. Let's see if that shows up in SPX, what levels, or sorry, SPY. So by Friday, let's see what, yeah, we've got 643 indicated by Friday and 8. A week from there, 640, and then options expiration day, 640, 645. We have some at 630 here also. That might roll off because there was this exposure 0 DT, so that might, but I didn't see it last week, so cancel that. 640, 645. Okay, so those are levels I'm going to be looking at for potential hitting that in the SPY over the next couple of weeks. And that 640 is right there. That shouldn't be a problem at all. Okay. I might as well denote to myself that that's mid-month. Okay, so can we hit that by mid-month? Absolutely. Even if we just kind of move along, all right? Or if we move along like this. That's even a lower slope than we've been moving along. So that completely believable, completely believable. Okay, so what might do better than the S&P? What I'd be really interested to know is after this, we're saying there's probably less likely that we're going to have a rate cut in September. What does that do with the SPY versus Russell? So in other words, well, we're not going to get any help in terms of rates. Rates are very important, much more important to small cap stocks than they are to large cap stocks. And does that mean a risk on environment so that the small cap stocks now start surging upwards? So far, there's not a reason to believe that it would be, but we could be wrong, right? Just because it's not logical or we can't draw the direct relationship doesn't mean that it might not happen. If people really go risk on, then they're going to look for the higher returns, the higher growth inside of the small cap stocks. If they're just like, oh, we still need a little bit more safety, then they'll stick with the large cap stocks. So that's what I want to see. I want to see what IWM is doing. We kind of know that SPY, at least for now, looks like that trend can resume. So look at IWM post-market. Unlike the SPY, it's down, right? The SPY has those mega caps. It has Meta. It has Microsoft to pull it upwards. And so far that is not translating into IWM. So that means we're not super risk on. And I'll have to see tomorrow because of course this is all after hours. So there's a limited amount that there are limited options for people who are still deploying capital after hours for them to go into. So for example, they can't just start buying up small cap stocks after hours. Most of them won't be available after hours. So we could have a delayed reaction tomorrow, but at least so far the evidence is that, yeah, it's probably going to just stick around inside of that SPY, those large cap stocks. Hi, Kirk. Good to see you. All right. So let's take a look at a couple of ratios, SPY, GLD. Okay, so gold doesn't seem like it was going anywhere, so SPY is still gaining on gold. SPY, Bitcoin. Not much movement. SPY, Dow Jones. Definitely gaining on Dow Jones, so it looks like tech is SPY XLK. Yeah, tech is still leading SPY, and then let's go SPY QQQ. Flat. So, or slightly down, because QQQ also has those mega caps and other tech inside of it. Okay, so it looks like we're reasonably risk on, like I should say mildly risk on. And then let's take a quick look at sectors that we might have moved into today. So we had a reversal. Home builders are at the bottom today. Semiconductors, which is interesting because we saw that out of the three big semiconductor companies that reported today, two were down, one was up. And so fairly muted, balanced out. But then we've got leisure and entertainment. So this is discretionary, and utilities. That's interesting. Biotech, crypto, still in play. Okay, so let me take a quick look at what's happening at utilities. Then I'm going to look at discretionary and specifically leisure and entertainment. Yeah, nice bounce off of the EMA 8, but hit that resistance. So we really need to see it get above there. So we may chop around for a little bit before moving higher again. And then we've got XLY, discretionary. Baby, mild uptrend. So it could continue post-market up a little bit. And then leisure and entertainment, same thing, stronger than overall XLY. You can see still just made all-time highs last week, bouncing off the EMA 8, but getting stuck at that, EMA 20, getting stuck at that EMA 8. So we need to see that poke back up above the EMA 8 and hopefully close above today's high before we got really comfortable with that. Okay, so I'm not seeing anything wonderful. Gold down. Let's look at gold miners. Down, yeah, so just gold overall, not looking great. It's not out for the count yet, but there doesn't seem to be any rush to go into gold, and this is probably mostly due to US dollar. Yeah, US dollar continuing to gain strength right there. So this is something that you'll want to watch. That US dollar, if it starts moving and trending, like if it's trending the same way that it trended downwards except upwards, the same way it was over here, that's going to have an effect on quite a few things, quite a few markets. So this is something, especially if that's highly directional. So we're going to definitely want to keep our eyes on the dollar and what that does. Okay, so today I said that we would talk about some earnings and potentially look for some earnings plays. Normally for earnings, it's hard to do after market hours because if you want the opportunity, you want to have as much information as you possibly can before you go in if you're going to trade the overnight earnings. There are other ways to play it, like we could go 2 weeks ahead, a couple weeks ahead, play that volatility. But if you wanted to do the overnight, your best probability, your best chances to get as close to the close as possible and then execute your trade, because that's where your market maker moves and the things that we use in order to do earnings plays are going to be the most accurate, or at least the most up to date. So I need to decide if I'm going to try to do an overnight trade for something that is reporting tomorrow afternoon, or tomorrow is Thursday, or Friday morning. Okay, so either Thursday afternoon or Friday morning. But if I do that, whatever trade that I set up right now, it could be undone by tomorrow's session. So the setup wouldn't be the same anymore. And so basically it would just be a purely educational type of setup, and you wouldn't necessarily have the opportunity to actually trade it. Or I can try to look for something a couple weeks out, see if I can take advantage of a volatility rush. Probably, I think I like that idea better. At the risk of doing something and then having the market completely negate it tomorrow, and then you guys, some people won't realize that and try to trade something that was no longer appropriate. Okay, so let's look at earnings. Where is, oh, I gotta pull it back up. So let's go mid-August. Okay, then I'm going to sort by market cap. I want the large market caps. Walmart, that could be interesting, although they don't experience a lot of volatility. Home Depot, TJ Maxx, the Lowe's, these are going to be really important earnings, but they may not experience a lot of volatility. Target, Estee Lauder, so a lot of discretionary and cyclical consumer staples type of stocks. Let's see. Let's just go for the big boy, Walmart. If we go out to August 22nd, yeah, it's $5, $5.6 is the implied move on a $97 stock, so about 6-ish% is the current implied move. And so I want to see their volatility around earnings. What is going on here? No. There we go. And I need to go a few years out. Okay. It didn't change. Why didn't it change? There we go. Okay. So what I'm looking for here is actually, I guess Maverick could help, but I actually want to directly look at implied volatility. Why don't I have implied volatility? That's weird. Anyone know what implied volatility is called on TOS? It's been too long. Implied volatility. Here we go. Imp volatility. All right. Okay. So we got earnings right here. We see that it spikes up not a huge amount. Here it did really run up. Here ran up. So we do get runs up in implied volatility on Walmart. You can see that currently that implied volatility is very, very, very low. And on the previous earnings, it didn't really go up that much. On this one, it did. On this one, it did before, well before. This one, it did. This one, it did. This one, sort of, not really. So it's interesting that the last one really didn't have much of an implied volatility move. So that's not giving me, I mean, normally it does, but do I want to bet that it's going to, or since the most recent one didn't really move all that much? So I prefer not to make that bet. So let's go to Home Depot and we'll take a look at that one. Nice big volatility move right here. Then over here, a nice volatility move. Here, yes, yes. This one was, yeah. So the answer on Home Depot is much more consistently yes. So I'd rather do this on something like Home Depot than on Walmart. So basically, what I'm going to count on is over the next 2 to 3 weeks, volatility in Home Depot. You can see that it's already increasing right there. I'm going to count on it continuing to increase until we get to earnings. And rather than playing their earnings event, I'm going to see if Home Depot trends or at least has a run up in volatility into its earnings. All right, so let's take a look at Home Depot, see if there's any good trend right there. I have a feeling there's not going to be, but yeah, that's chop resistance over here, so that's not ideal. TJ Maxx lows. TJ Maxx could be. Lows, Medtronic, and Target. Okay, so I'm going to look at Medtronic and TJ Maxx. Not a huge implied volatility move. Here there was. Here, not really. Here, yes. Maybe. Yes. Yeah. Okay, so that's not super encouraging. And then TJX. Oops, TJX. Nice long-term trend in TJ Maxx over here. It's been chopping recently, but it broke above that MA50. So that is room to run, or at least maybe challenge those all-time highs. We've got applied volatility starting to move up and increase. We had a nice move in the previous quarter, a very nice move in the one before that, nice move in the one before that, before that, before that, before that, before that. Okay, so looking good. Looking good. So TJ Maxx is going to be my candidate. Okay, so now I get to decide how I want to play this. Okay, so basically increasing volatility, if my price goes nowhere, if TJ Maxx goes nowhere, and just say just chop sideways right into earnings, well, I'm going to lose on time decay if I do a basic call, right? If I'm thinking that this is an uptrend, a W-shaped recovery, bounce off of the MA200 twice, retest, go back up, poke above the MA50, pull back to the EMA20, and bounce from there back above the MA50. We just need that MA50 to start curving back up. Everything else, all the other moving averages are already curled upwards. It could be the beginning of another leg upwards. It could be a little W right here. So I wouldn't want to play that through earnings, but maybe this continues to move upwards into earnings, and then we could take the trade-off from there. If I do a simple call, then I lose out on time decay, but that increasing volatility will negate some of, if not all of, that time decay. So that makes it easier for me to go into a straight up call. But then I got to ask myself, is that the best way to play this right now? Because a lot of times we do chop into earnings because we know a high volatility event is coming. So either we just wait for that Or sometimes market players will start to make bets and be like, oh, we think earnings are going to be really good. We think we have some excellent research or insider information that tells us that it's going to be bad. And so they'll start positioning themselves beforehand, and you might see that drift upwards or downwards into earnings. So I'm going to be inclined to play something that is either that drift upwards or sideways movement or a combination of both of those. A combination of both of those would be like a debit spread, debit call spread. Or I could do a straight call. That would be the drifting upwards idea. And in this particular case, I don't need aggressive movement upwards for a simple long call because my increasing volatility negates at least some of the time decay. So it can just float upwards and I'll still be okay. I could also do a butterfly, either centered where we are right now if I think it's not really going to move all that much, or I could center it a little bit higher if I think it's going to drift upwards. I could do a broken wing butterfly so that even if it aggressively moves higher, I'll still benefit. I just won't benefit as much as if it just slowly floated upwards. So there's a lot of little things that I can do right here. So before I make that decision, I'm also going to see what happened in previous earnings. Did we run up into earnings? Here we did. Into this earnings, we chopped sideways. To this earnings, we ran up. Into this earnings, we kind of sort of ran up. This one we ran up. This one we ran up. This one, I'm starting to see a pattern here. We ran up. This one sideways. This one down. This one movement. So more likely to have movement than not. Okay, so I'm going to lean now towards something that, hey, there's probably going to be some sort of movement. I answered your question. Oh, I didn't even, what kind of strategy would I use? Okay, all right. Yeah, we're answering that right now. Hi, Kay. Okay, so now that tells me I either want to do that long call. I can do a calendar, a longer dated calendar, or I can do a butterfly. So let's go ahead and compare those three. So if I was just going to do a straight up long call, how would that look? All right, so again, I don't care as much about time decay anymore. But in order to minimize that, I would try to go out to, well, I'll just buy at expiration, an expiration near the actual earnings date. If I'm going to do that, I want to go in the money. I'm going to minimize time decay. Plus, I want, if I'm going to go at expiration, I want it to still retain some value at expiration. And then if it moves up, the other thing is, we get closer to a $1 move for each $1 in the underlying move as well. Then, of course, it's leveraged, so that $1 move is a lot more meaningful, a higher percentage move against $5 or $6 than it is on $97. This is Walmart, so I'm looking at the wrong thing, but the principle applies. Okay, so let's see. I have TJ Maxx in one of my programs. So let's see. Obviously, different strategy though. Okay, because we're not talking. I'm talking about an in the money call right now to take advantage of earnings. So extrinsic value, you can see that this gets really choppy and inefficient. So these are highly expensive and large bid-ask spreads. So I want to go something that's better priced, but you can see like this one is anomalous, right in between that 114 and 129. Suddenly there's a strike that is super cheap compared to those two. And we see that bid-ask spread, for whatever reason, is a lot tighter than those around it. And if we can get this 30 cents on a $9, almost $10 option, that's not bad. That's not a bad bid-ask spread. So this could be a good candidate if it still looks like this when we open. And I like that one quite a bit. Okay, so let's model this one out. A $1.17 strike. Okay. So what that means is by expiration, which is a little bit later than their actual earnings date. When is their earnings date? August 20th. So a couple days before expiration. All we need is for TJ Maxx to go up to 126.6, and then we would have, that would be break even for us. That would be at least some profit. Okay, so the question is how hard or easy for it to get there? Look, we opened right there today. So it'd be super easy for us to be right there, and if all it did is chop sideways, my loss is going to be minimal. Okay, so if we stayed exactly at 125.8 all the way until expiration or 2 days before expiration, all I'm going to lose is that 79 cents of extrinsic value. So I'll lose $79 on my $9.50 or 60 cents invested. Okay? Not too bad, not too bad. So that reward risk potential is fairly good. Okay? So if let's pick a target and just say we have, what is that, 3 weeks to 20 days, roughly 3 weeks. So we'd expect that it can make maybe a 2 to 2.5 ATR move. So 2 ATRs, let's just be a little conservative, would be $3.40. Okay, so $3.40 would make that 129.2. So I'll just call that 129.25. Okay, that's my kind of conservative target to the 20th. Okay. So then we say, based on how it's moved so far, could it get there? Yes, no problem. If we just draw the slope of that target, and I should just put it right there, is that doable? The answer is yeah. It just kind of has to, that's not an aggressive drift upwards. It can do that. That is reasonable. Okay, so if it does that, if we do make it to 129.25, by the 20th, just before the announcement, so just a few minutes before the close, and we make it to 129.25, that's like 29%, 29% gain, which is okay. It's not 100 or 200% gain. It's okay. It's not bad. So I risk a little bit at the risk of going nowhere. I'm not really at risk of moving down significantly. I have a whole bunch of support right here. But let's just say if we break today's low, we're out, which would also be breaking the MA50 and breaking the EMA8, potentially going down to the EMA20, which, so you could say, okay, no, sure you don't want it to break EMA20 because there's some support there also. Well, we don't want to get our reward risk off too much. So let's just say if it goes down to 125.25, so if it goes down to 125.25, right, 14%. So we're risking 14% to make 30%. That's roughly 2 to 1. So that's not bad. That's pretty good. That's a good trade right there. Good reward risk ratio. Let's see though, maybe there's a better way I can capture this better than just a straight call. And I could do debit. I might as well. It shouldn't take too long to model that up. And so if we do 120, what did we say? 122, 125. So if I sell the 125 and I buy the 124, and my break-even point is now at 124.58, which is lower than my break-even point, or than my stop-out point was for the straight-up call. Okay, I have a max loss of 57, we'll call that 60, and a max gain of 40. So that's a 66% gain on my risk. So that's my profit potential. So already I'm doing better than that TJX, except in terms of return, yes, I'm doing better. But in terms of reward risk, I'm doing worse, right? This is slightly worse than 1-to-1, whereas this one was a 2-to-1 reward risk. So I have to understand what I'm trading here. I'm trading a higher risk in order to get a higher return. So that, at least I'm not trading a higher risk for a lower return. Okay, so at least that relationship is correct. And so the degree of that I'm increasing my risk versus the degree that I'm increasing my potential reward, that is the trade-off. That's what I want to evaluate. I also have a better, at least ostensibly a better chance of profit, because even if it chops nowhere in this instance, I'm still going to realize that full 66%. Whereas if it's chopped nowhere, then I lose my $79 right here. So which is, I don't know, less than 10%. 8.2%. Okay, so both of those are looking like decent trades. I want to see if I can do even better though. So I'm going to do one more. That one's going to be a long call butterfly. I'm going to center it right around where I think it could go. All right, so we said that was 129.25. So I'm going to center that at 129. Okay. And if I want it to be safe, similar to these guys, I would say, well, I want my lower break-even point. It'd be nice if it was right around 125, 124. Okay. So can I do that? First of all, is that possible to create that? We've already created it. So let's, what is that? $4. Okay, you see that? My break even 125.11, 132.9. So that means that if we float down or chop nowhere, by the time we expire, I could make, look at that, 28%, 29%. That is similar to what we expected on TJ Maxx or the straight long call if it actually reached our target. So this is already matching that performance, except the price doesn't even have to move, and I can match the performance of that long call. Okay, but what if it actually hits our target? Then I would make 185% on my risk. That is way outperforming the other two structures by far. 3x on the debit spread and 6x on the straight long call. What I really like about that is, what's my reward to risk ratio? My max reward is that 389. My max loss is 210. That's still a 1.5 to 1 reward risk ratio. So I'm getting kind of the best of both worlds multiplied versus the other two trades. So this is also looking really excellent, because if I'm really just expecting chop, and then so now the question is, what if it reaches our stop out point, 125.25 on the long call? Well, guess what? That's still inside my break-even zone. All right, so I'll make a very small amount of money. Well, I'd make 6.1%. So I mean, that's further above zero than I thought it would be. So it's still pretty good. Okay, so as long as it just doesn't just break down, then we're good. And then look what we did here. We actually made a broken wing butterfly. So I was actually talking about this trade. And if we're completely wrong, you might maybe be comfortable with holding this through earnings simply because there's really not much risk to the upside. I still wouldn't do it though. TJ Maxx current implied move out to that date is $6.50, 131. So basically it would be up here. So, I mean, at least the market maker doesn't think it's going to go up there. So let's see why this was a broken wing. This is 6 difference. I only gave 4 right here. So let's do this. Okay. Break even lower. So everything I said about the break evens, fine. Even better reward risk ratio. Excellent. If we go right, we pin it at 129, I have 243% possible gain. So that's 4 times better than the debit spread and 8 times better than the call. I'm still, my break-even point went even lower. So that's even better in terms of, hey, I'm still not taking a loss if by the time I stopped out of the straight long call. And my reward risk ratio now is way better than, it's over 2 to 1. So it's even better than that debit spread. So this long call butterfly is looking pretty good, right? It's pretty good right here. I risk a 175 to, the chances of you actually making 425 are low. So we're not going to count on making 240%, but what are your chances of making like 100%, right? Like how wide of a range you have. If it moves up anywhere in between 126.5 to 131.5 before expiration, you've already made 100%, which again, clearly outdoes this, even the debit spread. And then what if it happens super fast? Okay, great. What if it happens by mid-month? That's still 59% gain, or very close to the 66% gain that you would have to wait all the way until expiration on that debit spread. So I love butterflies in my personal trading. I don't do it a lot in my programs because people have trouble following along. They don't like having so many legs, but there is a lot of advantages to butterflies, I think, as you're seeing through this comparison. So one of my favorite ways to trade earnings, whether it is leading up to earnings or even post, if we're trading the night before earnings, is with a butterfly. Of course, calendar spreads are excellent as well if you're trading immediately before earnings. And then I like doing double calendars as well. So trying to capture something in the upside or downside if you're having that binary earnings event. So that, because you don't know if it's going to go up or down. So having a double butterfly can be really excellent. But in this case, we're playing the lead up, that implied volatility move upwards into earnings. And so just take a look at this. If we're not at earnings yet, just say we're at the monthly expiration, August 15th, mid-month, and volatility does increase like we think it's going to do. Okay, so all it does is say, oh, we make money a little bit slower. Right? That's the difference between the butterfly and the long call and the debit spread. We make money a little bit slower if volatility really begins to move, but this implied volatility doesn't matter at expiration. Right? So I can move this all I want at expiration. It doesn't change that curve at all. It only changes it on the way to expiration. And so that's why I like to pick that expiration date very close to the earnings date. So that way I don't have to worry about the implied volatility too much in my butterfly, because it's within 2 days, this expiration. If it was an entire week, then I would care a lot more about this implied volatility. Okay. Any questions about that? Hopefully you guys are learning a lot. Repeat the strike for if the long call example I gave was August 22nd, 117. Of course, this is not advice, and I'm not advising you guys to actually take these trades. Right? I have to cover my butt and say that. If you take these trades, they're your own discretion, and you can look at the risk rewards yourself by charting it out like I did over here. So 117 call, if you're more interested in just a simple straight call, August 22nd expiration, we compared that to August 22nd expiration of a 124, 125 call debit spread. And then we compared that to the butterfly, that is long 123 strike call, short 129 strike calls, and long 135 strike call. Yeah, we can, why not? Let's save this. Let's save all three of these, and we'll compare their performance as we get closer and closer to the earnings event. Okay, yeah, you're welcome, Lise. All right, I think we are just about out of time. We did that. Great timing on this. Again, hope you guys are learning a lot of things that go into a trade, considering it, how we compare trades, how we optimize opportunities. Again, so if we were looking at the entire process, we would say, what are the 4 parts of a trade? You have the trade idea, you have the timing, you have the execution, you have the management. The trade idea is that there oftentimes leading up into earnings, we have a volatility rush and either a flat or directional trend as people are positioning themselves into those earnings events. Based on the studies that we did, the historical chart, the historical implied volatility, the historical behavior of TJ Maxx around earnings, we decided that there was a higher probability that it was going to move upwards into that earnings call, and that implied volatility would continue to increase. So that is our trade idea. In terms of timing, our timing is right now because earnings is coming up in a few weeks, and we want to capture that implied volatility move. So there's your timing. Your trade execution was a choice between the call, the debit spread, and the butterfly, and I made that evaluation. I personally preferred the butterfly, but some other trader could easily prefer a different one. And so we each decide on our execution, and they could have done a completely different trade than what I selected over here. There's so many ways of executing. I decided for me, I favored this particular execution, but I am going to save and track all of them. And then then it just comes down to management, right? And management, if we hit that target before earnings comes along, I'm just going to take the profits on this. And for this, we would go all the way up until just before earnings. And this one, if we don't hit that 129 before earnings, then I'll close it on the same day. And same with this one, same day, except I also have a stop out price of 125.25. And then that's about it. That's it. That's the management. But we'll watch, maybe we'll track these daily going into earnings and take a look at their performance, and that way you'll get to see that management process as well. Okay. All right, guys. Yeah, you're very welcome, Zen. All right, everyone, have a wonderful rest of your day, and I'll see you guys